In this paper, I analyzed the causes for the large differences in college enrollment rates between the poor and the rich in Mexico. And in particular, I'm interested in the role of heterogeneity in people's expectations about returns to college. Why am I looking at this question? In Mexico, an income gradient is, of course, present in many countries. But this income gradient is particularly striking in Latin America and in Mexico in specific. So let me give you a little bit of background information to motivate the context that I'm looking at this question. Latin America is characterized by relatively low levels of human capital investments compared to countries of similar per capita income. It's characterized by large inequalities between poor and the rich, in terms of education, in terms of earnings, in terms of wealth. In recent decades, we've seen rising returns to college, but actually the attendance of the poor has responded very little to these increases in returns to college. And something that is also important to know for Mexico, when I look at Mexico, that is around the year 2005, there was a very limited number of student loans and fellowships available. And so I think that this is an interesting context to look at the role of what can explain this income gradient. Here I'm plotting college attendance rates by parental income quartile, and you can see the striking differences. So here, if someone comes from the richest income quartile, his likelihood to attend college is more than 8 times as large as coming from the poorest income quartile. Of course, what we would like to know is what is driving this correlation. Can we interpret this correlation as causal? Is there an actual causal impact of parental income on college enrollment, or is parental income proxying for other things? Now, there are a couple of theoretical reasons for why credit constraints might be relevant in the context of human capital investment decisions, such as, for example, lack of collateral, important moral hazard problems. Still, we'd like to know the empirical relevance in a given context in order to derive policy implications. And other explanations have been brought forward and have been shown to be important, in particular in the US, such as, for example, differences between poor and rich in terms of college preparedness, in terms of how much the poor and the rich can actually benefit from college when going to college. Now, if I do kind of a very simple approach, following for example, Kanner and Heckman, I look at this income gradient and I want to see how much remains if I control for cognitive ability and other abilities using similar measures that have been used in the literature. I see that the income gradient is still present. Now, can we interpret this then as credit constraints or not? We might be worried that maybe our measures of skills are imperfect. Maybe we cannot measure all the different skills that are relevant for affecting the expected returns to schooling, etc. But now, what we're really interested in knowing, or what we would like to do, is basically open people's heads and understand what were the expectations that they had about lifetime earnings in the college state and in the high school state, to understand their decision to go to college or not. And these expectations, of course, depend on these different, many different skill dimensions, or better, they depend on the perception of each individual about the different skills, and also they depend on the information that each individual has about how these different skills are priced in the market. And this is a second dimension in which there might be heterogeneity between poor and rich that could cause the income gradient that we see. For example, in the Mexican case, most of the poor, or basically none of the poor, have parents who have actually gone to college themselves. They might know very little people, or very few people who have attended college, and maybe they have very little information about what careers are out there with a college degree. And so, in order to capture this, I'm suggesting an approach here in this paper that is based on eliciting people's expectations about high school earnings and college earnings directly to analyze and to discuss with you later on if this can help us understand people's educational decisions and thereby also understand what is driving this income gradient or these differences in college enrollment. This data also allows me to look at another dimension, and that is people's perceptions about labor market risks that are related to college and having a high school degree. And I can see in how far these risk perceptions also might play a role in understanding differences between poor and rich in terms of college going. Now, what's the challenge of answering this question of understanding what is driving the income gradient? Well, we have to look at the individual's choices under uncertainty, and this depends on several different sources of unobserved heterogeneity that I classify here into three different parts. One is people's earnings expectations, which, as I said, we don't observe directly, people's preferences, and potentially credit constraints. And having these different sources of unobserved heterogeneity poses a fundamental identification problem when we would like to separate these three different components and understand better what is driving the income gradient in college enrollment. And as I will argue in this paper, I'm going to use data which will help us in addressing this identification problem by providing direct data on people's earnings expectations. So just to be more specific, how does this data help me in this analysis? It can help me distinguish between the following two explanations for the income gradient. I can see whether poor people do not go to college because they expect low returns, as I have expected returns for each individual. I can look at this directly, and I don't have to go through the different selection issues, etc. Or is it that the poor Mexicans require higher expected returns to be induced to attend college than rich Mexicans? Now, if I find that the first explanation is the relevant one, there are still two different channels that lead to this finding, and that it could be that the poor rationally expect lower returns than the rich because they lack the important abilities that they need to benefit from college education, as has been shown in the literature. Maybe they lack connections, which might be important particularly important in Latin American countries. But it could also be that they lack information and potentially they underestimate the returns to college that they are out there. And so if I find that the first explanation is important, we need to go deeper into understanding the causes for this, which is not going to be easy. But I try to convince you that this data, having data on expectations, understanding that poor Mexicans expect low returns is kind of the first step towards understanding better what is driving their low college attendance rates. In the second case, of course, I need to dig a little bit deeper. If I see that poor Mexicans require higher expected returns, it suggests that they are somehow prevented from going because they face higher costs than rich in a very broad sense. So higher costs in the sense of higher direct costs, higher borrowing costs, higher psychological costs of attending college. And then we will need to look at a model looking at these different components, having data on these different components to understand better which of these components is actually relevant and driving the gradient that we see. And of course, as is obvious, these explanations differ substantially in terms of the policy implications that are derived from them. And as I said, using earnings expectations will allow me to account for heterogeneity in people's information sets, and I'll be very specific about how I'm going to do this in the rest of the talk, and about the data, the exact data that I'm going to use, so we can discuss about the usefulness of the data later on. I'm not going to discuss the literature on credit constraints very much because all of you know the literature as well or better than I do. Instead, let me very briefly tell you a little bit about the literature using this type of new data on people's subjective expectations. There's a seminal paper by Dominic and Mansky proposing this type of elicitation method, and he shows that people are willing and able to answer these questions in a meaningful way. later papers have linked these expectations then to actual choices. For example, this paper with Orazio Attanasio, we show that having data on people's expected returns and risk perceptions helps us to predict their schooling decisions. We can also use it to understand a bit better the intra-household decision process when making educational decisions, in the sense that we can see if it's parents' expectations that are relevant for these choices or youth expectations, and this helps us to understand a bit better what is the decision process in the household. Okay, one other related paper is with Luigi Pistaferi. I'm mentioning this because this is also on heterogeneity in information, and here in this case, we look at the case that the individual might have superior information than the researcher about future income, and we are analyzing in how far this can help us understand the puzzle of excess smoothness of consumption that we see. In particular, you can see that people respond much less to permanent shocks than predicted by the permanent income hypothesis. And one explanation that we put forward is that people actually have superior information. So what the researcher calls a shock is actually anticipated by the individual and acted on from the perspective of the individual beforehand. And disentangling the anticipated and unanticipated components of income, we can achieve this using data, again, on subjective expectations. And this helps us to show that in the context we look at, anticipation is actually very important. Anticipation of income changes due to promotions, etc. Lance has a paper on perceptions about the possibility of being arrested when committing crimes, and how these expectations are formed and how they affect decisions later on. And there are several other areas where people have used this data to understand better people's decisions under uncertainty. So let me spend some time describing the data, because I think people are less familiar with this part here, and present some descriptive results using this data on expectations. And then I'll show you in the second step, I'll set up a very simple model of college attendance and show you how I use this data in this model to derive testable implications of credit constraints, and also, if I have time, perform some counterfactual policy experiment. Just as a quick preview, subjective expectations of returns to schooling help to predict schooling decisions, but they are not able to fully explain the large differences in enrollment rates between poor and rich. Okay? Differences remain even after controlling for differences in expected returns between poor and rich. Something I can show directly with this data is that it's true that poor people require higher returns to be induced to attend college than rich people. Okay? Because I have directly data on people's expected returns. And also, I find that it's poor, high expected return people who are particularly sensitive to changes in direct costs of schooling, which I will show is consistent with credit constraints playing an important role. And in the counterfactual policy, in the analysis, I show that students who are induced to college due to changes in direct costs, for example, these students at the margin have expected returns that are as high or even higher than those already attending, suggesting again that they are prevented from attending by very high costs that they are facing. Okay. The data that I'm using is a survey called Jóvenes con Oportunidades on adolescents between grade 9 and 12, so between ages 15 and 18, whose families are Oportunidades beneficiaries. And I'm saying this because this is one limitation of this data, that I only have about the poorest third or so of the population. So the analysis that I'm doing is based on a comparison between the very poor and the less poor, okay? Instead of comparing the very rich to the poor. And this is going to make it a bit harder to find evidence of credit constraint, and this is leading to quantitatively, it's going to lead to an underestimate of the importance of credit constraints. But but we will see if there are credit constraints, even if under this tough conditions to look at this issue. This data is nice in the sense that it has very extensive information on schooling histories, on individual and family background characteristics, a lot of ability measures that are used in this for addressing this question. And in particular, it contains a module on people's subjective expectations of earnings. So for example, for the lower cohort of junior high school graduates, we asked them about their expectations for three different scenarios. Junior high school, what if junior high school is the highest degree? What if senior high school is going to be their highest schooling degree and they stop school afterwards? And what if they continue on to college? Oh, sorry, there is a mistake here. So while the cohort we are interested in is the cohort of senior high school graduates, so we're looking at people who have finished senior high school, who then decide to go on to college or not. And for them, we asked them the two relevant scenarios of what would be your earnings if senior high school is your highest degree, what would be your expected earnings if you continue on to college and finish college. So these are the two scenarios we are interested in. The questions that we're asking to these senior high school graduates is, first of all, a question on the probability of working. So we asked them for the two different scenarios. We asked them from 0 to 100, how certain are you that you will be working at the age of 25? And then the follow-up question concerns the earnings distribution. So we asked them, conditional on having a job at the age of 25, what is the maximum amount that you can earn per month at that age? What is the minimum amount you can earn per month at that age? And an additional question on the probability that the earnings are above the midpoint, where the interviewer computes the midpoint. Okay. Now, one drawback of this question is ideally we would have liked to ask this question for different points over the life cycle. Unfortunately, we haven't done this in this survey. We're now going to the field and doing this again. So right now we have just 1 point over the life cycle. So I need some additional assumptions about the life cycle profile just to tell you in advance. But age 25, so the majority of people, even when you go to college, you will have finished by age 25. Now, with this information, what are the pieces of information we have? We know for each individual and for the two scenarios of high schooling degree, we know the minimum earnings that people expect, the maximum earnings, and we know the probability above the midpoint. Okay? Now, this is not sufficient yet to determine moments of this distribution because you need an additional assumption about how the distribution looks like. That is, do we have a stepwise uniform distribution? Do we have a triangular distribution? We do this with different reasonable distribution, and we can show that the results are robust with respect to that. In particular, the first moment is actually very similar whether you use, for example, a stepwise uniform distribution or the more reasonable triangular distribution here in this case. And with this additional assumption, you can obviously compute different moments for this individual earnings distribution. That is, you can compute for each individual the expected earnings. The variance of earnings is one measure of earnings risk. And we have this question on the probability of work, which captures the unemployment risk that people are facing. So before I go into the main analysis, let me convince you a little bit, or try to convince you that this data is actually going to be useful in capturing something useful. Okay, so it's less relevant to know if the expectations are actually objectively the right expectations. What is important is that we are able to measure the beliefs that people have when deciding about going to college or not. Okay. But to show you that the answers seem pretty reasonable, I show you how these expected earnings compare to actual earnings that people currently in the labor market are facing. And again, note that the expectations are elicited in 2005 about earnings in 2012. So at most, we could go back to the field now and ask them about their actual earnings. Right now, I use census data in the year 2005. So the first thing is this comparison to show you that earnings expectations are actually pretty much in the same ballpark like actual earnings. So people seem to be reasonably well informed about what earnings they could have. Secondly, I show you how expectations vary with individual characteristics. And if people have pretty good idea about the earnings they could make, we would think that expectations should vary with individual characteristics in a similar way as actual earnings vary with individual characteristics. Okay, so that's one thing that we can show, and we can also show that how expectations vary with earnings realizations in the same municipality. Let me show you this very quickly. So here I'm comparing expected log earnings to log census earnings that we observe. And here for the older cohort of people who have finished a high school degree, we can compare the expected earnings with a high school degree to the actual earnings, observed earnings in the labor market. And you see that they are surprisingly close to actual earnings that people have in the labor market. In terms of expected college earnings, people are expecting college earnings apparently to rise. Remember, these are earnings which will be realized only 7 years later into the future. And so expected college earnings are slightly higher than the observed college earnings that you see in the labor market currently. In terms of how do expected earnings vary with individual characteristics and actual earnings that they are facing, that they see from people around them, you can see that people who live in a municipality with very high junior high school earnings, for example, they also expect higher junior high school earnings themselves, and similarly with senior high school and college earnings. So you see a positive correlation there. In terms of individual characteristics, you see that people with higher ability or better school performance, they expect higher earnings in the labor market for all different schooling degrees. People from richer families expect higher earnings. People who have a father who is an employer, who owns a small business, expect higher earnings. You know, these are things that we would expect, and that suggest that people are reasonably well informed about earnings on average. Now, something that is important to mention is that even if we control for all these different individual and family characteristics, there's still an important part of unobserved heterogeneity in these expectations. And one question is this all measurement error, or does this actually capture additional information that can help us predict their decisions, right? And so what I'm going to show you next is basically, if I just simply run a reduced form regression of the college attendance decision on all these different individual and family background characteristics and put in the expected returns, do these expected returns explain something in addition to all these other measures that we have? Then they must contain some information that the individual has that we usually don't have in our data in terms of the characteristics that we usually observe directly. Okay, so let me show you this in the second step. So here, as I said, the dependent variable is the 0, 1 variable attend college or not. You can see that the expected returns to college are strongly significant in this regression, and they remain significant also when you add other characteristics. Now, something I think interesting that you see is if you add ability measures or school performance measures or parental education measures, you see that the coefficient goes down a little bit. So you see there is a positive correlation between, so people who are more able actually expect higher returns, as we would assume. Now, in principle, when we want to understand people's decision, what is relevant is really their expectations about labor market earnings, right? Not ability directly. So in this sense, we shouldn't, once we include expected returns, we should not include also these ability measures. Now, the reason for including these ability measures is that what I don't control for here is the probability of actually being able to complete college. Okay, this is one important variable which obviously affects the returns to college in the end, and this is one reason for controlling for these ability and education measures. Another reason is that probably people differ in terms of preferences for education or psychological cost, and so that's another reason for including these measures of school performance and parental education to capture these different aspects. Now, after controlling for all these different individual characteristics, including expected returns, we can see that parental income is still an important predictor of the college attendance choice. Okay, and this is I also control for direct cost measures such as distance to college and tuition costs that's the minimum tuition of the universities in my municipalities, which are relevant cost measures for the sample that I have here. Okay, so these distance measures are actually very good in the sense that if people go to college at all, the people in my sample mostly go to the closest college. Okay, so this cost measure is really capturing the kind of direct cost that they would be facing to go to college. And you see income is still significant afterwards, which motivates a further analysis that I'm going to show you now. So that's basically the first result, that we see that differences in expected returns cannot fully explain the gap in college enrollment between poor and rich. Mm-hmm. Mm-hmm, mm-hmm. Right. Well, in the sense that if you think that people internalize that working hard will imply higher returns later on, this should be captured in here. So unfortunately, we don't have measures of hard working, but I would like to show you that expected returns also depend on on your motivation, on your determination, and so on. But as I will show you in the model of college attendance, in as far as this is relevant because of increasing the returns that you get to college, I think this should be captured in this measure. If it's instead affecting kind of your preference for going to college, this would be something that you should include here. Okay, and possibly this is captured by this. So for this reason, I don't want us to claim here that this relationship shows you that it's income that is relevant. So this is just the motivation, and now I'm going to show you, setting up an actual model. Using these expectations, I try to convince you, come up with testable implications, and try to convince you that it's really income and not alternative stories that you're suggesting. But then we can, when I show you the test, we can come back to your possible alternatives and see if I can exclude these alternatives or not. Before getting to the model, let me just show you very quickly one last descriptive results, and that is, which I think is nice because the data that I have allows me to show you this directly, which usually we cannot do. Okay, usually we never observe individual returns, not even ex post, so I cannot do this comparison of comparing the returns that the poor require to be induced to attend, and comparing this to the returns that someone who is rich requires to be induced to attend college. And here I can do this pretty directly by estimating a locally weighted regression of the decision to attend college on the expected returns that people are expecting. Okay, and so here I plot the probability of college attendance conditional on these expected returns. For example, if we look at an expected return of 0.6, we can see that conditional, or for this expected return of 0.6, the probability of attending is about 45% of rich people attend with a high return like this, while among the poor, only about 25% of people attend. Okay, so rich or poor people require higher returns to be induced to attend college, and we would like to know more about what is causing this. Okay, so let me briefly set up this simple model and show you how I'm using the data on expectations in this model, and then derive testable implications. So what are the critical assumptions of this model? in this model, I model credit constraints as heterogeneity in the interest rate, Ri, which is unobserved. In this model, I assume that individuals are risk neutral, which implies that this whole problem simplifies to simply maximizing the expected present value of lifetime earnings net of costs. Okay? Of course, this is, you might be worried that this is a strong assumption. In particular, you might be worried that the poor are more risk averse than the rich, right? And if going to college is a risky decision, then this might be driving at least part of the differences in attendance between poor and rich. Now, something I think interesting that I can show you with this data is that in terms of perceived labor market risk, people perceive college to actually be the less risky alternative. So one thing, they perceive that unemployment risk is clearly lower with a college degree, which we would expect. And also in terms of earnings risk, so in terms of the variance, perceived variance of earnings, they perceive that college earnings are still as risky or even less risky than high school earnings. Okay, so this would not be a problem here in the sense that this should also make, if poor people are more risk averse, it should make them attend college even more than the rich, okay, taking this factor into account. Of course, there are other dimensions in which college might be more risky for the poor. For example, the risk of dropping out, which is something that I don't have a good measure of in this data, but I'm trying to control for this by using past school performance, okay, to use as a proxy for the likelihood of dropping out of college. But here, as an approximation, I'm assuming risk neutrality here. Then I assume that individuals have the same discount rate. If it's true that people are not constrained, the discount rate should actually not affect their decision because they just maximize the expected present value of earnings, and then they distribute their income across periods as they like. So in this case, differences in discount rates don't matter. If we have credit constraints that are present, then discount rates, of course, matter in the sense that if you have a strong present preference, it's even more costly for you to decide to go to college. And here in this context, I'm going to use some additional evidence based on health-related decisions that people are making in terms of trading off future and present, such as, for example, smoking, heavy drinking, and things like this. And I can show you that in my sample, there are basically no significant differences in terms of these sort of proxies between the rich and the poor. So I think this is not going to be a really crucial assumption that I'm making here. And fourth, I need some assumption about how labor market experience evolves over the life cycle, because, as I said, the expectation question was unfortunately only asked for one point of the life cycle. And so, as I said, assuming risk neutrality, the decision problem simplifies to maximizing the expected present value of earnings, given that the individual has a probability of completing. The individual either completes college and gets the expected present value of college earnings, or he or she does not complete college. And here, for simplicity, I assume that in that case, the individual receives just the high school earnings. Okay? So that's the very simple decision problem. And already here you see that what is relevant for this decision is the expectations about future lifetime earnings for the for the scenario of having a college degree and for the scenario of not having a college degree. Okay, given the information that the individual has at the time of making the choice. And this is something that some information we need. Usually, we use earnings realizations to infer about people's earnings expectation. Okay. Now, one immediate problem that you see is obviously we never observe the counterfactual. So we have to make some assumption about how people form their expectations given this sort of self-selection problem. Are people aware when they form expectations that other people have self-selected into college or into high school? Are they aware of this or not? you need to make some assumption as a researcher about how individuals are dealing with this problem and how they form their expectations. And also you need to make some assumptions about the information set of the individual, right? You need to assume, for example, if there are large shocks that happen to earnings after the college attendance choice, were these shocks anticipated by the individual or not? And here I suggest to use this approach where I use people's expectations elicited directly and see if this can help us understand their decision. Okay. Now, let me show you how I'm using this data together with the assumptions about how experience enters in this process. At the time of deciding about college, people face two potential future earning streams. One is the earning streams with a college degree. One is the earning streams with a high school degree. And I model them here as depending on time invariant individual characteristics, labor market experience, potential labor market experience. And in the usual RAI model, we have an unobservable U, which is unknown to the researcher and assumed to be unknown to the individual as well. Okay, and I separate this into two components with a factor structure where the first component is an anticipated part of the unobservable, so it's something that the individual knows at the time of deciding. And this could be, for example, this F is a vector of skills, theta is a vector of skill prices, and so in as far as the individual knows more about his own skills or his parents' connections, etc., this would be included in here, and this would be something that the individual could act based upon, right? While me as a researcher, I don't observe this part directly. And using people's the data on people's expectations, I will have included this anticipated part directly, right? And so this is something that I'm going to use then in the model of college attendance. I'm not going to, due to time constraints, I'm not going to derive this. I can show you that basically the decision simplifies to yes? Sorry. I'm right. So I'm sure there is some measurement error in people's expectations. So I haven't taken this into account in this model, which I should, and we should talk about this more. I'm convinced there's quite some measurement error in there. Yes, but what is relevant is there some component which is known to the individual, which I don't know. Okay. Okay. So let me show you a first test of the existence of credit constraints, which is in fact which you can compare to Chris' paper. They derive a very basically the same prediction can be derived from their model of college attendance, and that is the very intuitive prediction that people who face a high interest rate are more sensitive to changes in direct costs. If you increase direct costs, of course, the person with a high borrowing rate will be more sensitive because he faces this additional borrowing cost. And so they would respond more strongly to these changes than someone who faces a lower interest rate. And so what I'm doing here first is I test for excess sensitivity of the poor to changes in direct costs, such as distance to college. Okay? And so for this reason, I was arguing that this distance to college measure, I think in my context, is actually a pretty good measure, in particular because this is the minimum distance to college, which is the relevant measure for the people in my sample, because most of them, if they go to college, it's in fact the closest college that they usually go to. Okay, so this is really affecting their direct cost of college. So how do I implement this test? As I said, I'm using dummies here for the distance to college. So the excluded category is distance less than 20 kilometers or less than 12 miles or so, which is a distance that people might be able to commute directly. And then I include and I look at what happens if I increase this distance to 20 to 40 kilometers or more than 40 kilometers, and how do people respond? Okay, and I want to see in particular if people who are poor respond more strongly than people who are rich. And in terms, so this is basically the proxy for what is the borrowing rate that people are facing. Now, what are the categories that I'm using here? Here in this case, I'm using income thresholds that are related to governmental programs. So the first income threshold is twice the minimum wage, which the government declares as the people who are particularly in need, and they would have priority for a lot of government programs. The second threshold would still be people in need, but less in need than the first category, and then the people who are richer in my sample. And I can do the same thing with the using an indicator for parental income and wealth, and use quartiles of this indicator, and you get exactly the same result. And one thing you see is that if you have this increase in distance, on average people respond negatively, so the likelihood of going to college goes down. And this is particularly true for the poorest. Okay, so here in this case, if you compare the response of the poorest to the richer ones, the response is significantly different. The poorest respond significantly stronger. Here in the second case, the differences are not significantly different in terms of how the different income categories respond in this case. I can do a similar thing with this second measure of cost, which is what's the minimum tuition that I would have to face in a university which is in my municipality, or which is closest to me, and 750 pesos is the median tuition cost that people are facing. So if I increase the minimum tuition cost that people are facing, in particular the poorest respond negatively, but here in this case not significant. And now one kind of extension, or one addition that I do for this test is that I check, it's maybe not sufficient being poor, which means that you're credit constrained. If you're poor and you have very low expected returns, you might not want to go to college in any case, right? Even if you decrease direct costs to zero, these people would not decide to attend college. So who are the people who are at the margin of being affected? It's those people who are poor and who have high expected returns. Okay, these are the ones who could possibly be responsive to these changes in direct costs. And I can use these expected returns, the data on expected returns, to test this additional prediction here in this case. And this is in fact something you find that it's in particular the poor with high expected returns who really respond strongly to this increase in direct costs. Okay. So far the results are consistent with credit constraints. Let me show you one last test, and this is one of the last slides. I'm nearly done. So what I'm going to do is I'm going to use this model for counterfactual policy experiments, but this is more as an additional test than to actually do welfare analysis. So while I've been arguing that knowing people's actual beliefs about returns is important for understanding their decision, if I want to move to kind of a welfare analysis, I would not really like to have their beliefs, but I would like to have actual earnings, actual returns, right? And so for this reason, I don't want to push this too hard, given that people's expectations on average seem to have been pretty reasonable. Maybe we can keep this in mind, but I don't want to push this aspect of welfare analysis too much. While what I want to do is, this is in some sense another test of credit constraints, because what I'm doing is I'm deriving the average expected returns of those individuals who would change their attendance decision in response to the policy, and compare this to the average return of those attending. So this CARD has basically suggested evidence that IV estimates are larger, significantly larger often than OLS estimates. He has interpreted this as evidence for credit constraints. Carnero and Heckman have shown several reasons for why this comparison between OLS and IV is not the correct comparison. In particular, what you would like to know is you would like to know the return of those who are treated, the return of those who are attending, which is not necessarily equal to the OLS estimate, right? While here in this case, I don't need to rely on OLS. I can directly compute the average return of those attending. And also, there are several concerns with respect to IV estimates, such as is the instrument, can I use this instrument or not? And here in this case, what I can do is I can use an instrument, but I can actually test the validity of the instrument in the sense that I can check whether expected returns are correlated to what I'm using as an instrument, such as distance to college. Okay. So here in this case, it's not literally that I'm using an instrument. I can see if what I'm varying, the cost that I'm varying, if this is correlated to people's expected returns or not. Okay. And so I can kind of improve this test on these two different margins and compare what happens if I'm changing, for example, direct costs to college. If I'm estimating what would happen if we reduce costs, for example, through fellowships or student loans, etc. And so I do kind of three different experiments. One is introducing kind of a means-tested fellowship or loan. That is, I vary I decrease the cost, but only for the very poor. The first one, I decrease the cost for all, and in the third case, I decrease the cost. I basically pretend that I have a policy which gives loans or fellowships based both on merit and means, and I give I decrease the cost for the very poor and the very able. And if I do this, I find that the marginal expected returns, first of all, they are increasing. If I concentrate on the poor and I concentrate on the poor who are very able, the marginal expected return is increasing and is, at least in the last case, is in fact significantly larger, or at least as large as the average return of those people who are already attending currently. Okay, suggesting that poor people are prevented. They have high expected returns, but they are prevented from attending because of constraints that they are facing. Okay, I think I'm out of time, so let me leave it at this and give Salvador the floor. I think this is on already.
Or there it is. So let me just, for starters, this is a very nice paper, right? And it's actually much more comprehensive than the presentation shows. In a sense, she's trying to do a lot of things on the paper, right? And she's trying to rule out much more explanations and a lot of stuff that she couldn't show. That being said, I always think of my goal as a discussant and poking holes in papers, not summarizing them. You just saw it. You don't want a summary. So I'm going to try to poke holes on the paper, not because I want you guys to think, oh, you should hate this paper because of the holes I'm going to show you, but because I'm trying to understand some stuff, right? So when I was trying to understand this paper, the first thing I did is I went back to my Becker notes, and I was trying to understand how we think of credit constraints, or at least how I was taught to think about credit constraints. And so this is the standard Becker graph, where you have investment, you have money, and so you think there's a return to going to college, and there's poor people, there's rich people. Rich people can invest up to the point where the return equals the interest rate. Poor people maybe can't, right? So they have a higher return, and that's as far as they can go, right? And now, the way Becker, thankfully he's not here, so he cannot correct me. The way I understand Becker thought about the problem is, oh, human capital cannot work as collateral, so the poor investors are going to invest until they can, the rich until they equalize returns, and if the poor could promise to pay back the rich, then the rich would lend them money, right? Because they could get a higher return than they can get if they just invest in themselves. $1 more. Now, this is sort of thinking of credit constraints as an amount that you're constrained. It's isomorphic to thinking of it in terms of interest rates, right? I could also say that what happens is the poor face that interest rate, so they're only going to invest until that point, where they equalize their returns to their interest rate. So it's a credit constraint that arises from this feature of human capital. Now, the question in my mind when I was reading the paper is, why is it that what you have is a credit constraint? So what you're I mean, I understand all the advantages of using expected returns, but what you have is expected returns. And so there could be informational asymmetries, right? So in some sense, if I think of this graph as a graph of expected returns, not actual returns, then the poor may be convinced that they will have high returns, right? Their expectations say I will have high returns, but the rich may be convinced that the poor won't have high returns. That's it. Why should they lend them any money, right? Why is this a constraint in some sense? So why should the rich or anyone, the government or anyone for that matter, finance the poor's investments? They may be delusional, right? They may think that they're going to have a high return, but that may not be true, right? So again, so I'm trying to make a point. So let's open slavery, say, right? So let's say that I can use human capital as collateral. The rich may still not want to invest, right? So the source of the constraint in Becker's model is that, but here if I eliminate that, the fact that because I have another source, which may be, for example, as informational asymmetries, the rich may still not want to invest on the poor, right? More importantly, the poor may not want to be invested in, right? Because if I include risk in my model, what's happened is if there are market incompleteness, right? So I cannot insure against the case that the return is not realized. I may be sure that I'm going to get a high return, but then I won't get it. Then I may be doing the optimal thing by just investing up to that point, right? I may not want you to come knocking on my door and say, okay, it's time to pay back, right? Because I have no insurance, right? So the point is, what I was lacking in the paper is what market failure do I have in mind, right? So in Becker's analysis, he proposes a market failure, and out of that arises a credit constraint. Here, we're kind of trying to extend the Becker intuition, but it's not clear to me, right? What's the market failure? So does it generate a credit constraint? Let me just say, by the way, that this is me pouring my heart out of how confused I am about this problem. So feel free to educate me, right? If you think what I'm saying is completely insane. So let's ignore everything I just said. And let's think of credit constraints as capacity constraints. I like to think of them that way. It's easier in my mind. And so now in a life cycle model, they could arise again. I'm going to propose a mechanism. There's a repayment constraint, right? Aya, Gary, Bewley, Huguet, Leitner. Every time I talk about this, everybody tells me to call it something different. So those are all the names, I think, right? So they would arise out of that. The borrowing constraint would arise out of a repayment constraint. But then if we think of this as the source, then you should have excess savings, right? So the whole point of these models is that there's going to be a lot of savings now for self-insurance. But now you're going to have another implication to try to distinguish other models, which is for the more constrained, arguably the poor, they should have excess savings. And I think in the paper at some point you mentioned that they actually don't have any savings. Now you never interacted with what their expected return is, so it may be that within the poor, the ones who have expected returns have higher savings, if they are the ones that are more constrained. So my question is, what is the market failure you have in mind? And for my money, every time I see one of these papers, I want to think of what is the borrowing constraint here? What I want to think about is market failures and how they prevent me from doing consumption smoothing. I think if we, for me at least, it would be much more useful to try to think of it in that sense, and then derive implications out of that, out of the fact that I cannot do consumption smoothing. Okay, so end of my confused, so enough BS, right? So now, is it surprising that expected returns do not predict who goes to college that well? They weren't to me, because we've been finding that, at least in the US, that well, right? I didn't say they don't predict. Because we've been finding that for a while now, with very different methods, very different people. I guess the simplest way this is reflected in the literature is AFQT predicts college attendance, but conditional unschooling, AFQT doesn't predict earnings. So that essentially tells you that expected returns are not going to predict college attendance. AFQT will. Again, I'm simplifying. So there is a role for ability to explain schooling beyond expected earnings. And I guess to some extent you are trying to control for that by including GPA. But I go back to Christina's point that you're also controlling for family income. And family income may be outstanding for other types of ability. I mean, we've had all this literature on different kinds of abilities. So what about psychic cost, right? And the relation to all of these abilities, the literature seems to think this is a big deal, and I include myself. I think at least that this was, in part, the driving force behind starting to investigate why is it that ability differences arise, right? I mean, it doesn't seem that returns explain it. It seems like the psychic cost explain who goes to college, and it seems like abilities explain the psychic cost. Well, maybe then we should explain where these ability differences came from. Okay, the paper is a lot about the advantages of elicited expectations. Not a big fan, but if we, I mean, in some sense, if we're going to believe that we can elicit expectations from, as Chuck puts it, carefully worded questions, then why don't we just elicit preferences from carefully worded questions and get over with, right? I mean, we could have gone and asked these guys, can you tell me the monetary value that you place on actually being able to go to college, right? And forget about expectations. I mean, why not get the preferences directly? Second minor point. So I'll buy all the advantages of actually observing the expectations of the agents, but in your particular case, given all the assumptions that you have to do after that, then it's not clear. I mean, as a general point in the paper, the advantages of having expectations, I'll take them. It's not better why, given that you had to chop a bunch of legs and arms to be able to do it, given the limitations of the data, it's not entirely clear in the end why we're better off. But of course, I'm just trying to plug in my work too, so take that with a grain of salt. Well, income maximizing, you talked about it. I mean, that's problematic, especially for what you have, because if I have a more general problem, then I'm going to need to know the information set at all points, right, in the life cycle of the agent. Not only what they think about the future today, but at any point in the agents, I'm going to need to know that, right? And then elicit expectations. I mean, we may have to wait 40 years and keep asking them at every point in the life cycle, which we may be able to do. Finally, so I love the idea of going and looking at Latin America or poor countries. I mean, if we're going to find credit constraints, it's more likely that we're going to find them in poor countries. And if we're going to find policies that have a lot of bang for our buck, it's probably going to be in these countries too. Now, Mexico is particularly problematic in my case because of migration, right? Especially in the group of people that you're looking at, which is the poorer of the poor, when you ask them what are their prospects for how much money they're going to make, one of the prospects that they have in mind is, well, I could just say screw that and move to the US, right? Regardless, or illegally if you want, most likely, and make much more money than I could make in Mexico anyway, right? And so now the decision process should include that. Yeah. So I think it's a little problematic, that's all. And so the final key point, of course, is, so sure, I think we would be hard-pressed to find somebody who says there are no credit constraints. I think one of the questions, and this is a point that Carneiro and Heckman make, is, well, fine, so there are credit constraints. Now, how important are they? Like, how many in the population are we talking about, and so on, right? And I mean, I understand with the data you have, it's going to be very hard because you have a subpopulation of a subpopulation to begin with. But I mean, I would have liked to see some discussion about that.